The Federal Reserve just triggered a recession, and millions are about to feel the shockwaves. Did you know that similar rate hikes in the past led to economic downturns within months? This decision could mean job losses, rising prices, and financial chaos for everyday Americans. If you're worried about your savings, investments, or future stability, this video is your must-watch guide to understanding what's happening and how to protect yourself. Stay tuned, because what's coming next could change everything you thought you knew about the economy. And don't forget to like and subscribe. This is crucial information you can't afford to miss. Now, let me show you why this is so urgent and what you need to know before getting started. Breaking news. The Federal Reserve has just raised interest rates again, and many experts warn this could trigger a recession. But what does that really mean for you and the economy? In this video, we'll explore the immediate and long-term impacts of this decision, explaining how higher rates can slow down economic growth, increase unemployment, and cause prices to rise. This is especially important right now, as the U.S. economy faces uncertainty and many people are worried about job security, savings, and investments. Whether you're a beginner trying to understand what's happening or someone with some knowledge looking to stay informed, this video will give you a clear picture of what's coming next. You'll learn how past rate hikes have led to recessions, what signs to watch for, and how to prepare financially. By the end, you'll have a better understanding of the economic landscape and what steps you can take to protect yourself in uncertain times. But to make smart decisions, you first need to understand the economic landscape we're dealing with. Breaking news. The Federal Reserve has just raised interest rates again, and many experts warn this could trigger a recession. So, what does this mean for the economy right now? Let's take a look at the bigger picture. Over the past year, the Fed has increased rates by a total of 5 percentage points, pushing the benchmark rate from near zero to around 5.25%. This aggressive tightening aims to curb soaring inflation, which, according to the Bureau of Labor Statistics, reached 6.5% annually in the latest data, well above the Fed's 2% target. Higher interest rates make borrowing more expensive for consumers and businesses, slowing down spending and investment. Housing markets are already feeling the impact. Mortgage rates have jumped from around 3% last year to over 7%, cooling demand and leading to a slowdown in home sales. Meanwhile, the stock market has experienced increased volatility, reflecting investor concerns about slowing economic growth and corporate profits. On the employment front, the latest BLS report shows that job gains have slowed, with unemployment edging up slightly to 4.2%. Taxes may also rise if government revenues decline due to slower economic activity, and consumer confidence is waning as prices remain high for essentials like food and energy. Historically, these conditions, rising rates, inflation, and slowing growth, have often preceded recessions, as seen in previous cycles in 2001 and 2008. Understanding this environment is crucial. With that context in mind, let's break down the strategy you can actually apply. Recently, the Federal Reserve decided to raise interest rates again, and this move is causing a ripple effect across the economy. When the Fed increases rates, borrowing money becomes more expensive for everyone, from big companies to everyday consumers. Think of it like the cost of taking out a loan or mortgage going up. This higher cost of borrowing means many people and businesses might hold back on spending or investing. For example, buying a new house or expanding a business could become less attractive because the loans are pricier. As a result, the housing market slows down, with fewer homes being bought and sold. Companies also cut back on investments and hiring, which can lead to layoffs and higher unemployment. All of this reduces overall economic activity, and if it continues, it can lead to a recession, a period when the economy shrinks, jobs are lost, and incomes drop. This process is often called monetary tightening, and it's a strategy the Fed uses to control inflation, but it can sometimes go too far, slowing the economy too much. Key terms to understand include interest rates, which are the cost of borrowing money, inflation, the rise in prices that reduces purchasing power, and recession, a period of economic decline. When the Fed raises rates, it's trying to keep inflation in check, but the side effect can be a slowdown that might turn into a recession. Now, let's look at a real-world example to see exactly how this plays out in practice. Recently, the Federal Reserve raised interest rates to about 5.25%, making borrowing more expensive. Let's see what that means for a typical American homebuyer. Imagine you're looking at a $300,000 house. Using a mortgage calculator with a 20% down payment of $60,000, you'd finance $240,000. At a 5.25% interest rate, your monthly mortgage payment, excluding taxes and insurance, will be roughly $1,320. Now, if rates climb further or stay high, refinancing becomes less attractive and your monthly costs could increase. Over a 30-year term, you'd pay approximately $475,200 in interest alone, doubling the cost of the home over time. This increased expense can strain budgets, reduce discretionary spending, and slow down the housing market. For investors, rising rates mean lower property values. For example, Zillow's data shows that in recent months, home prices in certain markets have declined by 5 to 10%, reflecting reduced demand. If you bought a property for $350,000, you might now see it worth around $330,000, risking a loss if you sell. This scenario illustrates how higher rates impact affordability and property values. It's crucial to understand these numbers to navigate the current environment. But remember, this looks great, only if you avoid the common traps that ruin deals like this. Breaking news: the Federal Reserve has just triggered a recession with its recent interest rate hikes. While this news might seem alarming, it's crucial to focus on how to protect yourself from costly mistakes during these uncertain times. First, one of the biggest errors is poor credit management. In a rising rate environment, having a low credit score can lead to higher borrowing costs. For example, someone who ignored their credit report and missed payments may face much steeper loan rates, making homeownership or debt repayment more difficult. To avoid this, regularly check your credit report and address any errors or delinquencies immediately. Second, overpaying on debt or loans is a common pitfall. When rates climb, locking in fixed-rate loans before further increases can save you thousands. Conversely, floating-rate debts can balloon unexpectedly. A friend of mine who delayed refinancing ended up paying hundreds more each month, all because he didn't act early. Planning ahead and consulting with a financial advisor can help you lock in favorable rates now. Third, skipping due diligence when purchasing assets or investments can be disastrous in a slowing economy. Overestimating property values or relying on overly optimistic projections can lead to significant losses when prices fall. Always do thorough research, understand market trends, and avoid emotional decisions based on hype. Finally, neglecting to diversify your investments increases risk during volatile periods. Relying heavily on a single asset class can wipe out your savings if that market dips. To avoid those mistakes, here are the best tools and resources available right now. Breaking news: the Federal Reserve has just raised interest rates again, and many are warning this could trigger a recession. But don't panic. This is also an opportunity to protect and grow your finances with the right tools. First, check your credit health with platforms like Credit Karma. It offers free credit score tracking and alerts you to errors or fraud, helping you maintain a strong credit profile that can save you money on loans and credit cards. Next, for investing, use Investopedia's simulator or research tools to understand market trends and evaluate your options without risking real money. This helps you make informed decisions and avoid impulsive moves. If you're thinking about buying or selling property, Redfin provides real-time home listings, market data, and mortgage calculators, empowering you to act wisely in a shifting housing market. Lastly, consider using personal finance apps like Mint to track your expenses, set budgets, and identify areas where you can cut costs during uncertain times. Now that you've got the tools, let's talk about the first thing you could do today to get started. Breaking news: the Federal Reserve just triggered a potential recession with interest rates now around 5.25%. The economy is shifting, and it's more important than ever to take control of your finances. So, here's a simple first step you can do today. Check your credit report. Why is this important? Because understanding your current credit standing helps you spot opportunities to improve your score, manage debt wisely, and prepare for future financial decisions. It's a small action that unlocks clarity and confidence, setting you on the path to financial resilience. Just download a free credit monitoring app or visit a trusted site to review your report. Take 5 minutes now. This quick step creates momentum. It's the foundation for smarter spending, better credit management, and more control over your financial future. Remember, in uncertain times, the key is to stay proactive. By starting today, you're taking a meaningful step towards stability, even amid economic turbulence. Taking that first step is how every long-term success story begins. Let's look forward to what's possible when you stay consistent, adapt, and keep moving forward. Your financial resilience starts now. 5, 10, or even 30 years from now, the decisions we make today shape our future in ways we often can't see. Imagine staying consistent with your financial habits, regularly reviewing your credit, diversifying your investments, and making smart, deliberate choices. Over time, those small steps compound into real, lasting wealth. Picture this. By 2035, you own 5 cash-flowing rental properties, each generating steady income that frees you for financial worries. Or perhaps, you've built a diversified portfolio that weathered market ups and downs, thanks to your commitment to steady, disciplined investing. It's not about quick wins or shortcuts. It's about showing up every day, making thoughtful decisions, and trusting the process. The recent actions by the Fed, raising interest rates and tightening monetary policy, may seem intimidating now, but they remind us of the importance of resilience and patience. Because beyond the turbulence, long-term growth is still possible. Consistency, over time, creates momentum. It transforms small, manageable steps into significant milestones. And now that you see what's possible, here's how we wrap this up and take action. Start today. Check your credit report, diversify your investments, and commit to steady progress. The future belongs to those who stay focused and persistent. Your wealth-building journey begins now. Breaking news: the Fed just triggered a recession. What does this mean for you? In the short term, expect economic slowdown, tighter credit, and increased market volatility. But here's the key takeaway. Staying disciplined and proactive with your finances is more important than ever. Review your credit, diversify your investments, and keep a close eye on your spending. Remember, even in uncertain times, small, consistent steps build long-term wealth and resilience. So, to recap, despite the turbulence, maintaining solid financial habits and patience will help you navigate this storm and come out stronger. I want to thank you for being here and taking charge of your financial future. Your progress is inspiring, and every step forward counts. Now, I'd love to hear from you. What's your first financial goal for this year? Drop it in the comments below. And if you found this helpful, make sure to like and subscribe for more updates and tips. Also, check out our related video on how to rebuild your credit in a recession. It's packed with actionable advice. Remember, here at your channel name, we're all about empowering you with trustworthy, energetic guidance to turn challenges into opportunities. Stay smart, stay confident, and keep pushing forward. See you in the next video.